The markets are cracking, volatility is spiking, but this is exactly when disciplined traders look for long-term asymmetric opportunities. In today's video, I'm going to break down three high conviction leap setups that I'm personally looking at and walk you through why I like these names, their optimal expirations, strike prices, and how each setup benefits from a rebound over the next few months. Hi, my name is Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you're someone who wants to build consistent income, retire early, and take control of your financial future, make sure to hit the like button, subscribe to my channel, and share this video with your friends and family. If you are new to the options world and are simply looking to shortcut years of trial and error and avoid costly mistakes, check out my Launchpad Discord group, a link in description below. Inside, you'll get weekly trade alerts, learn how to open, close, and roll trades, master risk management, and even get direct access to me for any questions. Now, a quick disclaimer before we get started that this video is for informational and educational purposes only and should not be considered financial advice. I'm simply showing you my trades and how I trade, and I'm not a licensed financial advisor. With that said, let's jump in and get started. If we start off by looking at the S&P 500, SPX is currently trading around 6620, and then as you can see, it made an all-time high around October the 30th of 6920. So we're looking at about a 4.5% drawdown from those levels. Looking at the fear and greed index, it shows that we're currently in a state of extreme fear. And generally, you'll see that the market's in a state of extreme fear anytime we're in a situation of a drawdown, like the current market environment. Also, if you look at the VIX, which is the fear and volatility index, it's currently around 24. And as you can see right now, it spiked all the way from 17 on November the 12th to about $24 currently, showing the inverse relationship between the markets and the volatility. Now, with the fear and greed index showing that we're in a state of extreme fear, it reminds me of the famous Warren Buffett's quote that be greedy when others are fearful and be fearful when others are greedy. So keeping that in mind, right now would be a perfect opportunity to take advantage of the market downturn and invest into leaps if you have some capital on the sidelines. So with that, my first pick is none other than Robinhood. And even with the recent pullback, Robinhood's up 210% year to date, and it's up about 228% in the past 1 year. Now, here's a quick summary of the latest with Robinhood here on Yahoo Finance. So it goes on to say that Robinhood's experienced a significant stock volatility, up about 250% in the past 1 year. Recent strategic moves include a three-phase tokenization plan and a focus on capital protection amidst market uncertainties. Robinhood's implementing a three-phase tokenization plan to create a permissionless financial ecosystem, enhancing user engagement and trading flexibility. Despite market volatility, retail investors are net buyers returning to popular stocks, which suggests confidence in recovery and growth. Now, if I look at the Hood 6-month chart with all my nice indicators, I see that it's currently trading right under its 100-day moving average, and it's also trading right at the tip of the bottom of its Bollinger Bands. Now, those not familiar with the Bollinger Bands, a stock generally tends to trade within the Bollinger Bands 95% of the times. In instances where it jumps out of the Bollinger Band, it generally reverts back over the next few days. So keeping that in mind, as you can see right here, back on September the 5th, it came down to the bottom of the Bollinger Band and then jumped all the way back up to the top of its Bollinger Band. And then again on November the 7th, it came down to the bottom of the Bollinger Band and then jumped back up. Now, obviously, there's no guarantees in the stock market, but generally speaking, anytime we see a stock at the bottom of the Bollinger Band, we see a reversal over the next few days. So keeping that in mind, I like Robinhood for a leaps play right now. So with the leaps play, you generally want to go out at least 365 days or more. And in case of Robinhood, I like this January 15th, 2027 options chain. Now this is 422 days out from today, and I'm recording on Wednesday, November the 19th. So generally when I look for a leaps play, I target a delta of anywhere from 70 to 80, depending on the stock and how much capital I'm willing to invest. So keeping that in mind and looking at some of the strike prices right here, I like the 74 delta right now, which is the $100 strike price and is about $18 lower than the current price of Hood. Now also keep in mind that this has a lot of open interest compared to some of the other strike prices. If we go back to the 6-month chart for Robinhood, again, it's trading at the bottom of its Bollinger Band, but it made an all-time high of 153.86 earlier in the year. So keeping that in mind, I'm going to pull up this options calculator and go ahead and select the January 2027 options chain and the $100 strike price. And as you can see right now, one leaps options contract with the $100 strike price would cost us $4,262. Keeping in mind that Robinhood's 52-week high was close to $153. if you look at the calculator right now, and let's assume that a Robinhood does get back to $153 by mid-February 2026, then at that point, you would make $2,573, which is a little over a 50% return on your investment. And obviously, if Robinhood were to break that 52-week high and continue on to $163, then in that case, you would make $3,238, which would be almost an 80% return on your investment. My next pick is Amazon, ticker symbol AMZN. And if you look at what's been happening with Amazon in the past few weeks, Amazon just signed a $38 billion deal with OpenAI earlier this month. And this deal is a strategic move for Amazon's cloud business, giving OpenAI access to Amazon's custom infrastructure and NVIDIA chips, which it will be using for AI training. Additionally, in late October, Amazon announced plans to lay off about 14,000 corporate employees, framing the decision as an effort to reduce bureaucracy and refocus on strategic investments, including AI. Despite the broader economic concerns and layoffs, Amazon Web Services has shown strong growth, with net sales increasing 20% year over year. And just recently, Amazon's autonomous vehicle subsidiary Zoox launched free robotaxi rides in San Francisco in mid-November, expanding its service and competing with other industry players. Following these developments, several firms either reiterated or boosted the ratings and price targets for Amazon, citing positive factors like strong AWS growth and the OpenAI deal. Now, looking at Amazon's chart, Amazon's currently trading very close to the bottom of its Bollinger Band. Now, if you notice, the bottom of the Bollinger Band also coincides with Amazon's 200-day moving average. So I consider that level to be a strong level of support to enter into a leaps play for Amazon. So I'm going to go again to the January 17, 2027 options chain, which is about 422 days out. We have a 71 delta strike price that has a lot of open interest, actually more open interest than any of the other strike prices. I also like the 75 delta, which is the $190 strike price, slightly deeper in the money. If you go with the $190 strike price, which is a 75 delta, this would cost you about $5,800. But if you go with the 72 delta, which is the $200 strike price, which is about a $22 discount from the current price, that would cost you slightly less, about $5,200. So I'm going to stick with the 72 delta right now and go with the $200 strike price. Now, obviously, looking at Amazon's chart, it made a 52-week high of 258.60 right here earlier in November. So that would be my target if I were to enter into a leaps play with Amazon. So let's pull up the options calculator. I'm going to select the January 2027 options chain, and I'm going to go with the $200 strike price, which is the strike price that we selected. That was the 72 delta. And as you can see right here, one leaps contract with the $200 strike price expiring January 2027 would set us back by about $5,200. And then again, if we target the $258 strike price, and let's assume that Amazon does get to this $258, $259 strike price by mid-February, then in that case, you would make a 50% return on your capital. And then if Amazon does break that and go a little further, then in that case, you would make $3,162, which would be a little over a 60% return on your investment. My final pick for this video is SoFi Technologies. And if we look at what's been happening in the SoFi world over the past few weeks, on November 11th, just a few days back, SoFi announced the launch of SoFi Crypto, making it the first nationally chartered bank in the United States to offer crypto trading to its customers. The platform will allow users to buy, sell, and hold cryptocurrencies like Bitcoin and Ethereum within the SoFi app. A November 18th report from yesterday highlighted SoFi's robust financial results, including 11 consecutive quarters of profitability, a 30% year-over-year revenue growth in the third quarter, and significant increases in both products and members. In mid-November, SoFi's stock was up 116% year-to-date, but since then it has retreated along with the rest of the market and is up about 75% year-to-date at the moment. Now, looking at SoFi's 6-month chart, it's currently trading towards the bottom of its Bollinger Band, and the bottom of the Bollinger Band also coincides with its 100-day moving average. So again, I consider that as an area of strong support for SoFi. So looking at the options chain, I'm going to go out again to the January 15, 2027 options chain, which is about 422 days out. So let's look at some of the strike prices. As I mentioned, I generally like to target a delta of anywhere from 70 to 80, with a 75 delta being the sweet spot. Now, keeping that in mind, the 75 delta is a strike price of $22, which is about a little over a $5 discount from the current price. So I like the 75 delta right here. It also has a lot of open interest and volume. So if I go with the $22 strike price, one Leaps options contract with the January 2027 expiration will cost us about 1,070, almost $1,100. So looking at SoFi's chart, it just made a 52-week high of 3273 just this past week. So that would be my first target for SoFi if I were to enter into a Leaps play. So again, let's go to the options calculator and see what kind of a return we would make if we get back to that $33 price level. I selected the January 15, 2027 options contract, and then I'm going to go with the $22 strike price. So as you can see right here, one Leaps options contract, the January 2027 expiration date would cost us about 1,070. Now, I mentioned that my first target on SoFi, if I were to get into a Leaps play, would be about the $33 strike price because that was the recent 52-week high. If I look at the $33 strike price, and let's say SoFi is able to get back to the $33 strike price by mid-February, then you would make $414, which if I divide 414 by the 1,070 that we would invest by buying one Leaps option, that would be about a 40% return on your investment. And let's just say that if SoFi was able to break that and go all the way to $36 by mid-February, then you would make $668, and that would be about a 62% return on your investment. So that's it for today's video. If you enjoyed it or learned anything useful, please be sure to give it a thumbs up, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching directly with me or be part of my Discord community, click on the first link in the description below, and I'd love to help you out.